Thanks for joining us today again at Choice Awards. Perhaps we could start off this panel again with a quick introduction of each of your funds and basically what your fund is and what your main investment philosophy. Perhaps we could start with Priscilla.
Great, thank you. First of all, I'd just like to address our new name, Allspring. I think it's new to many of you and in fact new to me as well. We used to be the old Wells Fargo Asset Management and now we're an independent asset management firm. So we're very delighted to be here today and to represent our best risk-adjusted US equity fund to be being awarded this particular fund award. A little bit about the fund. The investment team basically invests in innovative companies with very strong fundamentals that are perhaps sometimes mispriced in the equity markets. As a result, this actually creates sort of a long-term growth prospects for such companies that are commonly misperceived. But we believe through very intensive fundamental research, this mispricing is actually a key inefficiency that our team can exploit through our investment process. And this really allows us to deliver strong long-term compounding returns through investing in businesses on the right side of change.
Thank you, Priscilla. Perhaps we could move on to Darshan. How would you describe your fund and your investment philosophy?
Thank you very much. Well, firstly, thank you to iFast and thank you all very much to the clients as well. Thank you for the support. So our strategy is a bottom-up fundamental portfolio as well. It's investing in winning franchises as well as more opportunistic value ideas. We source ideas from across the breadth of the European market. The portfolios are supported by a team of 20 research analysts and portfolio managers. We believe it's the best resourced team managing European equity products anywhere in the market. We conduct something like 2,000 company meetings per year. And so what you end up with is a concentrated portfolio with high active share, but with diverse sources of alpha.
Thank you very much. Moving on to Stephen with your Lion Global Fund. How will you describe it?
Right. So good evening, everyone. Before I describe about the fund, just a little bit about Lion Global. I'm not sure how many of you actually know about us, but we are one of the very few locally owned asset managers. So we are actually part of the Great Eastern Group. We are also part of the OCBC Group itself. So having said that, that actually gives us the heritage of being very strong in the Asian asset classes, especially in fixed income and also in Asian equities. So today we are here as award winners for this best 3-year risk-adjusted return for Singapore equities. Now I think for Singapore equities, it's nothing new to most of you. And I reckon that most of you here are Singaporeans or you have lived here, you have participated in the Singapore stock market in some way or the other. So for us, as a fund manager, this fund has been around since 1989. It's one of the oldest funds, so it's been more than almost coming to 40 years, or more than 30 over years. So basically, we are bottom up, as most managers will do. We believe there's inefficiency in the local market, despite being a small market itself. And for us, we do have a value approach. So we do not like to pay things or overly or pay excessive price for a stock that we like. So that is, in short, our product. Thank you.
Thank you very much. Finally, with Stefan, how will you describe your fund?
Good evening, everybody. Maybe let me start off by introducing Fullerton. For avoidance of doubt, we are not related to a hotel chain or a healthcare chain. Jokes aside, Fullerton has been around for quite a while. We are co-owned by both Temasek and NTUC Income. So we have a very strong heritage. What sets us apart from the others is we are not listed. We take a very long-term approach towards investing. We are bottom-up. We are growth manager. And the thing about investing in growth is that the returns can be very lumpy. So, you have 1-2 good years and like times like this, it gets a bit turbulent. So how we are able to still achieve the best risk-adjusted return is our ability to see the many shades of grays. No, actually you can see the many shades of growth. So we look at defensive growth, quality growth, structural growth, and cyclical growth. And if really we cannot find opportunities, we are very happy to hold cash. So I think this is how we set ourselves apart from others. Thank you.
Thank you very much to all our fund managers for introducing all our funds. Now on to the questions. We'll start with Priscilla. It's been a tough year for US equities, as you are probably aware. And I guess the question is, in the next 12 months, how is your fund positioning, especially given the rate hike environment, for instance? And are there any sectors specifically where you're overweight or underweight?
Great, thanks for the question. At the end of the day, we are bottom-up, fundamental-based manager. So all of our individual positions and sectors are actually a result of our investment research conviction and how their differentiated views are actually relative to consensus expectations. Having said that, I would say in terms of secular growth opportunities implicit in companies these days within the innovative sector, such as consumer discretionary, communication services, healthcare, and information technology, have resulted in some material portfolio allocations for us. On the other side of things, obviously, in terms of energy and consumer staples, we believe that the fundamentals and risk-reward profiles of many of these subsector companies do not really meet our investment criteria at this stage, so they are underweight sectors. And within financials, actually, other than the selected financial technology opportunities that we are looking at, we are very mindful how to shield the portfolio from interest rate sensitivity. Having said that, we continue to populate the portfolio with companies, as I mentioned earlier on the right side of change. So really this means, focusing on companies that have very visible growth paths and significant competitive advantages that is, fueled by, for example, disruption in technology. And I think this type of companies will merit, premium valuations over the long run. So yeah, thank you.
Thank you very much. Moving on to Dashan. It's a tough situation in Europe with high energy prices, high inflation there. So my question for you is, within Europe, are there any specific countries, sectors, or themes you like within Europe?
Yeah, sure. So you're right. It's been a very difficult year, and there's a tough economic situation in Europe as well, as you say, with that kind of higher inflation compounding what was inevitably going to be a kind of a year where global growth slows in any case. But we are fortunate in Europe to have many companies which are selling to global customers, so customers in the Far East, customers in the US, customers in China. And many of these businesses share some quite attractive traits, and this is across different sectors. So those traits might be companies with family ownership, companies with very strong corporate cultures or entrepreneurial corporate cultures. They might be companies which have very strong engineering expertise, or companies with extraordinarily powerful and enduring brands. And so those are the sorts of traits that we find across the European market, across different sectors. If I was to try and narrow down your question to three broad areas, I would say the first area that we are investing in within the portfolio is what we call giants in niches. And these are, the best way of thinking of that is kind of global leading businesses which are dominating quite niche end markets. So that could be particularly in precision engineering, it could be in luxury goods. Those are the sorts of opportunities we find there. Another area would be what you might call the green transition, so companies which are facilitating that green transition. And again, these are companies which have leading positions in electrification, automation, energy efficiency, energy security. Again, Europe is very fortunate to have some of the global companies in the world who are addressing those sorts of needs. And the third area I could categorize as valuation anomalies. Where at the moment we have a kind of shorter term positive view on banks. Over the long term, we find the banks in Europe relatively unattractive, but shorter term, we think there's a good valuation opportunity there. And also within the energy sector as well, where we have some positions as well.
Thank you very much. Moving on to Stephen. Regarding Singapore equities, Are there any specific sectors you like or maybe don't like as much within Singapore?
Singapore is a small country. I mean, we know our nation quite well. I think within the fund itself, we tend to overweight on the financials. I mean, with the reopening up of the economy, I mean, this is something that we have not been able to do in the last 3 years. I think that will bring about a boost in the earnings of a lot of sectors. I think hotels, tourism, airlines, financial is something that we tend to overweight for this particular, I would say, we have been slowly adding up positions into the financials. So if you look at the portfolio today, they are definitely in our top 5, and then they take up a significant amount of our percentage in the fund itself. I think airlines, tourism, I mentioned before. There are not many names in the Singapore market that kind of reflects this sector. So I can't be telling too much. If not, I'll get into compliance issues. But you know where we're heading. If anyone here trying to get a ticket out of Singapore in November, December, you know exactly how much you have to pay and how difficult it is to get a ticket. So that itself is a big growth driver, and I think that will continue all the way to 2023.
Thank you. Moving on to Stefan. Asia, another big continent as well. Do you like any specific countries, sectors, or themes within there?
Yeah, I think this year itself, our approach towards the market, you need to be very humble about it. As stock pickers, bottom-up stock pickers, we have chosen stocks that has beaten the analysts' forecast for 6 or 7 quarters, and the stock can still be trading down. So I think it's very important for us to take a very pragmatic approach towards stock selection this year itself. Notwithstanding, we think it's a very good opportunity for us to pick up good structural stocks, structural growth stocks. So, they have been beaten down, even though they have been beating analyst estimates. Notwithstanding, at this point in time, we are quite cautious of the market, so we are overweight the communication sector. We like telcos at this point in time. And within the country allocation itself, we like Singapore. It's not very common that an Asian equity manager come on stage to tell you we like Singapore. That is our biggest country overweight at this point in time. It's not top-down. I think there are a lot of tailwinds. My good friend Stephen here has mentioned some of them. So at this point in time, that's our view. Thanks.
Thank you. Moving back to Priscilla, perhaps you could walk me through your investment process at your fund. So what does the process look like from the formation of a stock idea to the actual purchase of a stock? How does it go for you?
Sure. So in terms of our investment process, we implement a very consistent basis regardless of actually the market conditions. There are 4 key areas of our investment process which allows our team to actually achieve this objective. The first is idea generation, screening ideas involving companies that, as I mentioned and alluded to earlier, on the right side of change. These companies embrace, innovation and disruption to displace some of the legacy industry incumbents. They have the ability to leverage on technological advancement to grow customers, gain pricing power, build competitive advantage. And we believe that this right side of change companies often benefit from changes in demographics, lifestyle, social, environmental trends as well. We use both a qualitative and a quantitative approach to identify this type of opportunities. The second one is research. We think that a unique way of doing this is to surround the company and make sure that we are looking through across all market cap sizes. I think with companies that have good trajectory in growth and free cash flow, this will allow us to sort of evaluate them, and as well as their current stock prices versus ours, right? And finally, in terms of portfolio construction, we actually allocate into three categories. We have what we call the core growth holdings. We have developing situations, and finally we have valuation opportunities. So for core growth companies, we are looking for companies that have sustainable financial growth, durable business models, and high visibility to the future outcomes. As for the developing situations, we are looking for companies that have, positive inflection in growth based on some sort of like a change in their business strategy or maybe improving fundamentals. And the third is the valuation opportunities, and this is actually the smallest allocation within our portfolio. But they are stocks with very attractive valuations and with some kind of near-term catalyst. So in all, overall, I think what we're trying to do is to balance the portfolio with consistent performance profile through a diverse market environment.
Thank you for the answer. Moving on to Darshan. Could you perhaps give one example of a stock pick that went well, and maybe an example of a stock pick that did not go so well? So again, what was the decision making like for each of these stock picks? And was there any profit taking or loss cutting at the end?
Yeah, absolutely. I'll just caveat that I'll name a couple of companies, but it's obviously not any recommendations. So an example of a stock pick that went well is a company that we've owned in the portfolio. It's called Tenaris, which is a leading company involved in making seamless tubes, which are used in the oil and gas industry. So the company makes tubes which are used for drilling, so drilling boreholes, casing boreholes. So when you're drilling for oil and gas, they build a case around the well, and also tubes which then carry the oil and gas to the surface. And this is a company that's got about 35% global market share. Its next biggest competitor has something like 20% global market share. So it's quite dominant in that industry. It's just recently reported in its Q2 earnings 20% profit beat versus expectations. They've increased their revenue guidance for the rest of the year by 10%. So everything's going very well operationally. It's got a net cash balance sheet, and they're continuing to build the net cash on their balance sheet despite having paid out a big dividend and also running a buyback program. So with that example, everything is going well. We did actually reduce the position size a little bit, just so a little bit of profit taking in that example, but we still hold the position in the strategies. An example of a company where it hasn't gone so well this year is a company called Lonza, which is a global leader in biopharma manufacturing. So it's basically manufactures the active pharmaceutical ingredient in drugs. A lot of the big pharma companies, be it J&J or Pfizer or AstraZeneca, will outsource the manufacturing of their drugs to a company like Lonza. So it's very dominant as well in what it does. Again, the operational performance of the business has been very strong. Its Q2 numbers showed about a 17% top line growth. They reiterated their margin structure, so margin corridor of between about 33 to 35%. They've maintained their guidance for the rest of the year at kind of mid-teens sales growth. So similarly to Tenaris, everything was going well, but in this case, the market has very, very aggressively derated that stock. It's a kind of what you might describe as a longer duration, higher quality growth type business. And as interest rates have gone up, the earnings multiple that you would apply to the share price has come down a lot, which has not been reflective of the fundamentals. So in that example, we haven't done anything with the position size. We still kept the position because in our view, the fundamentals are still extremely strong for that business.
Thank you very much for your answer. Moving on to Stephen. For your Lion Global Fund, could you perhaps provide an example of one fund holding within Singapore that is perhaps more unique and shows the team's willingness to perhaps pick something more off benchmark?
Well, earlier I mentioned that we like something to play along the tourism or the reopening of the economy. So I guess Singapore is a small island. Everything that comes in has go through Changi Airport, Right? I think that's a very strong hint. Well, I guess everybody's saying, okay, let's rush to buy SIA tomorrow, right? Because this is something that Stephen likes. Besides SIA, I think there are other ways we can play this team. So something a little bit off benchmark. This is not recommendation to buy, right? So, for example, we like SATS sets, right? Which is the airport terminal services. So, as we start to reopen, if I'm not wrong, I think a couple of weeks ago it was announced that we opened up Terminal 5, reopen Terminal 4. So many terminals that are closed and they're opening, and I can't even keep track. So whenever there's new terminals that's being reopened, airlines start to come in, we have more planes coming in, we need maintenance, we need catering, right? We need services, and this is where I think a company like SETS will be able to give us that participation on the recovery play, right? Without directly buying to, say, an airline, right? Another company that we tend to like in a similar scope, SI Engineering. So as all planes that comes in, about servicing, maintenance, etc., refueling, they will benefit somehow or the other. All right. So we do have positions in them. I'm not saying that are we adding or are we trimming. So, right, so that's not inducement for you to rush to the market tomorrow. But this will be some of the examples that we have, in terms of off-benchmark bets that we think that will add value to the portfolio in the coming months. Thank you.
Thank you very much. Finally, on Stefan. Again, could you walk me through your process within Fullerton? So again, how does your stock picking process go from start to end?
It's a very long question, and I think I will keep it to just the sell-side discipline part, and it will be a long night for you guys. So I think as a growth manager itself, it's not uncommon that our portfolio have the 2, 3, 4 baggers. So what is important for us is actually the sell-side discipline of a growth manager is very, very important. So one example that I would like to cite is Southeast Asia Internet Company that we had for a very long time. It was doing very well, and there was a wobble. And for us itself, we have a 15% discipline, which means that if any stocks drop by 15%, there is a auto trigger for us to relook at the investment thesis. And the analyst basically went back and said that, okay, it's done, the stock has done so well, went all the way up to 200, just dipped a little. It's important not to fall in love with your stocks. And this is what I always tell people, investment is not a relationship. You don't have to fall in love. It's not your wife or your girlfriends for some of you. Lucky ones, kidding. So the analyst actually went back and said that interest rates are rising. So it's a listed company, obviously, and they are funding losses. And when interest rates goes up, their cost of funds goes up. That is an issue. Second thing also, the internet company basically was expanding all over the place, South America and Europe. And after that, they have since closed down some of those businesses. So I think for us as a growth manager, and this is how we can, as a growth manager, achieve best adjusted return, is actually being disciplined in looking at the downside. That's all. Thanks.
Thank you very much to all 4 fund managers for your insights. To round off this panel, could we perhaps, in turn, could each of you please summarize a few reasons why you think your fund deserves a place in our investors' portfolio today? Starting with Priscilla, please.
Great. I think first and foremost, the first speaker that came up didn't make it very easy for me with regards to his US equity outlook. But listen, I think despite recent focus on inflation and tightening policies with the Feds, we still believe that, we don't believe that the current environment will be representing a new long-term reality. I think at the end of the day, circular forces such as demographics, debt, and disruption will certainly remain. We also believe that the US economy will ultimately return to slow levels of economic growth, and this will help to cool a little bit of inflation and maybe alter the upward path of interest rates. At the end of the day, when the returns of steady and modest economic growth come in, this will be a very nice tailwind for actually our type of investment style. And I think, investors' attention will eventually return to this type of innovation from leading growth companies. And also in terms of innovation and disruptive businesses that I mentioned earlier on, like the right side of change companies, they are ones with very strong fundamentals and sustainable growth that will be rewarded for the ability to navigate and grow in an environment of slow growth and high uncertainty. So essentially, as long-term investors, we look for companies that can compound growth over many years, and our experience is that fundamentals rather than sentiment will drive superior equity returns in the long run. Thank you.
Thank you. Moving on to Darshan. Could you please provide a few reasons why you think your fund deserves a place in our investors' portfolio?
Sure, yeah, thank you. The European market is different. The broader European market is different to some other equity markets around the world in that a lot of the largest companies in the market towards the top of the index are not really the most attractive ideas. Where you do find very, very attractive companies is generally a little bit lower down the market cap spectrum in the kind of mid-cap space, mid and small cap space. And within that sort of space within Europe, there are, as I've said earlier, some of the world's very, very best businesses. And so I think it's important for clients to have some allocation to those businesses in their portfolios. I think the other takeaway is that there's clearly a lot of macro economic concerns at the moment. The European economy is likely slowing, the US economy might be slowing, but it's worth always remembering that when you're investing in equity portfolios, the managers of those portfolios are buying units of company earnings and cash flows. They're buying units of company profits. They're not buying units of GDP. And many of these attractive businesses that we're all here talking about will continue to deliver attractive profits going forward, even if economic growth does begin to slow.
Thank you. Moving on to Stephen. Could you please provide a few reasons why you like your fund?
This is really tough because trying to sell Singapore equities to a ballroom of Singapore investors, it's like selling ice to Eskimos, right? Now, I'm pretty sure most of you will have some sorts of Singapore stocks in your portfolio already. So maybe the question you need to ask yourself in the last 3 years, has your Singapore portfolio that you put up yourself, be it REITs, banks, telcos, etc., have they been able to beat the market? When I say the market, I define as the STI, maybe if the MSCI Singapore Market Index. If the answer is yes, well done. Keep it that way. If the answer is no, maybe you want to take a chance with us, right? Because at the end of the day, it's about home-based buyers. We are more diversified. We have definitely more than 40 to 50 stocks at any point. So we are able to diversify for you, right? And also we are able to do the risk-adjusted and also the active rebalancing that maybe you don't have the time to do it yourself. So look at our own portfolio. And if you do like the stocks that you're holding, I'm sure we have them as well. And that we probably have more. So I think that's the only reason I can think of, right? Maybe you want to add, on top of your own Singapore stocks that you pick, add a Singapore equity fund that's been consistently outperforming the benchmark in the last 3 years. And last but not least, if you look at the current market, this year has been tough. I think dividend yields is looking a little bit better. So it might not be a bad time for you to accumulate a little bit more Singapore equities, add them into your portfolio, and just to cream some of the yields that we might have in some of the stocks, and that will add on to the overall returns. So that's my answer. Thank you.
Thank you very much. Ending on with Stefan. Could you give a few reasons why you think your fund deserves a place in our portfolios?
Maybe I'll try to answer the question with 3 whys. Why now? Why Asia? And why Fullerton? Okay, the first why is always darkest before dawn. In the middle of the Second World War, okay, the equity market started to rally. I know we are looking at our portfolio now and say, why are we investing? But the truth of the matter is that I think, I'm not here to call the bottom of the market, but quite clearly, this is a better time than what it was a year and a half ago. So I think we should continue investing, the first why. The second why is why Asia, okay? The last decade was developed markets, clearly it's outperformed. We think that the next decade could very well be Asia. The structural growth trend is still there. IFAS likes China. We think that Indonesia will do very well. India itself a bit pricey, but the structural story is there. And Asia is no longer following. In a certain technology, we are market leaders. LED, like in China itself, when it comes to a lot of green tech, Europe is there, but China is also there. So we think that have a part of your allocation into Asia. And the last why as well is why Fullerton. We believe that now more so than ever, having a benchmark agnostic, high conviction, we only own 20 to 40 stocks, very nimble manager. Our benchmark fund is having 10% cash. Our non-benchmark fund is having 30% cash at this point in time. So we think that having a nimble manager like us in your portfolio will help to navigate the volatility. With that, I thank you.
And thank you very much to our representatives from all our funds over here.